YouTube coming back to y'all with another video today. Third video in the series. Glad to say it. Today we are going to be talking about the one, the only, fair value gaps. This is going to be every piece of information that I wish I had when I started um, about fair value gaps, how to use them, how we can use it to our advantage, entering trades to formulate our bias, what they are, how they work, um, all that good stuff, fellas. So without getting started, let's get into it. I just need to boom. I always click the wrong one. Hold on. It's about to piss me off. Come on. Am I retarded? What the fuck? Got it. Got it. All right, fellas. I know this looks like a lot, but I mean, again with this example of this trade, this goes into a lot usage of fair value gaps. So it's going to be a good example for us to use. Um, but first, what are fair value gaps? FVGs stands for fair value gap. Obviously, it is a three candlestick setup pattern, whatever you want to call it. Um, for a bullish example, it is the first candle. The first candle's top wick to the third candle's bottom wick. First candle, second candle, third candle. Boom. Obviously, first candle's top wick, third candle's bottom wick. In this whole area, it's a void. Lack of sells are not, or should I say not, are not being pushed down into this gap. We are just bullish, bullish, bullish. This causes, you know, sells to come back down into this, fill this void of bullish price range, balance it out, and then, we either move towards a draw or we inverse it. Only two things can happen. Already looking here, as you can see, this is a bearish example. Um, I'm going to show examples later too, but boom. Oh, actually, first let me explain the bearish example. Bearish first candle's bottom wick to third candle's top wick. First candle's bottom wick to third candle's top wick. Boom, void, lack of buys. No buys are in this price range right now. What do we want to do? Buy back up into it and then sell off. What do we do right here? Boom. Bearish candles first. Wait, blah, 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 blah. Bearish first candle's bottom wick to the third bearish candle's top wick. Boom. Lack of buys in this area. What do? We push back up. We buy back up into this void of just bearish order flow, price action. What do we do after that? We sell off. It's as simple as that. Next, bullish fair value gap. It's a void in price action where bearish order flow, sells have not been, as I said, and then same for bullish fair value gap. It is a void of price action where, bearish. Bearish fair value gaps are a void in price action where bullish order flow / buys have not been. As y'all can see, it's pretty self-explanatory once you understand the gist of, what they are, how they work. But whenever a fair value gap is made, think about this logically. We have a series of candles. We have the body, the wick, making the candlestick, obviously. What am I saying? We have a full body of just bearish order flow. In order to make this fair value gap, we technically we do have to sell off here to make this wick, sell off here. So we opened down here, obviously. We went up here, we closed down here. That means we bought up here and then sold off a little bit. Boom. This next candle, boom, forming the body of the fair value gap. Sells have been here and here in these wicks. They have not been anywhere in here. So once we close this third candle up here, we want to sell back down into this fair value gap to then push out of it, inverse it, whatever price decides to do. And I mean, these can be used. I mean, should be used, not could. These should definitely be used for pre-injury stuff. Um, you can spot them on the high time frame too to formulate with your bias. We're gonna talk about that too. And I'm gonna explain, obviously, my trade here in a second about how I used fair value gaps to make me $712 on Wednesday. And even then, if I wouldn't have taken this trade, I would have made 1,500. So sucks to suck, but we are in the profit, boys and girls. Um, how can we use them? Obviously, like I just said, it is a retracement confluence. So what we're gonna do is, let me just boom, paste that, boom. Now we have retraced, boom, wick, wick. It's a retracement confluence. 3 candlesticks up, we get a big retrace down into this fair value gap. You know, you can use this. I use I forgot what this box is called. I believe it's right here. Oh, just a rectangle. But yeah, you add the line. So about a 50% mark. Well, technically, it is exactly 50% of this fair value gap was wick past. And then, what are we expecting to come out of this? I know this is gonna be a little bit mixed, but boom. We're expecting boom, boom. Don't mind these 3 candles. We're looking at boom, down, retrace, back up, and we are following bullish structure. Delete that before it becomes complicated. Boom. So that is what we're looking for in a bullish scenario. And then obviously bearish, we're going to want to, buy back up. Shit. We're going to want to buy back up into this fair value gap. Boom. And then what are we going to want to do after we buy back up into it? We're going to fill all of those orders and boom, we're going to sell off. Sell off using that fair value gap. Boom, boom. Boom, boom, boom. Simple. This is one of the most useful confluences you can ever learn. Actually no, I'm not gonna say in my opinion because it literally is. And also, while it being a retracement confluence, it can be an inversion entry confluence. So next, obviously this is a void of this price action. So of bearish, this is a void of bullish price action. So when we break under this fair value gap, making it an inverse fair value gap, it's not a fair value gap anymore. It's an inverse fair value gap. We inversed it. This bearish candle didn't retrace into it. It did. It did right here. Right after that, what do we get? We didn't get buys back up out of it. We got a clean breakthrough, and now this is an inverse, meaning I'm looking for shorts now. I'm looking for shorts after we inverse this bullish gap that did not hold. I mean, with this scenario, same thing, just opposite. Crap. Boom. What do we have? Bearish fair value gap. Boom. We retrace up into it. On the second candle, what do? We close above it, meaning it is now an inverse fair value gap. Now we're looking for buys out of this fair value gap. We're using this. You can use this confluence to be bearish or bullish. I mean, obviously, if it gets inversed either other way, you're switching your bias. But I mean, this is a great confluence to use if you know how to use it. Like I said, I would explain this. What do we have here, fellas? I'm not going to go over in the time frames because it's going to mess up my screen. But this right here is a 5-minute fair value gap. What do? We zoom in a little bit. Boom. We have a down candle. Hey, yeah, another thing, guys. It doesn't have to be 3 bullish candles. It can be bearish, bullish, 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 bearish, bullish, or the candles don't have to be all bullish for it to be a bullish fair value gap. As you guys are going to see in this example, we have up, down, bearish candle. What do we have up here? Boom. Oops. I'm looking at this fair value gap right here. This one. Boom. And then the candle is going here. Let me just move that. Boom. There you go. Now we can see it better. As I just said, we have bearish, bullish, bearish. This is a bullish fair value gap. What do? We come down, we retrace into it while the candle's still active. What do we end up doing? We inverse the crap out of this candle. Switching my bias was already bearish for this day, but when we get inverses on the 1 minute, that is an entry waiting to happen. I didn't wait. I entered off this next candle, this next candlestick. Boom, and we get our entry. So usually on the 1 minute, that is gonna be my, ride or die. That's my, entry confluence. Or we can retrace back up into it. Or we can do both, guys. So boom, right here. Like I said, it doesn't have to be bullish or bearish, all of them. Bearish, bearish, bullish. First candle's bottom wick. This is a bearish fair value gap. And then the third candle's top wick. What do we have? An imbalance in price action. What do we need to do? Buy back up into it, sell off to the draw. What do we do exactly as I'm saying? We buy back up into it, fill it, sell off into the draw. Obviously, we are going to be using these confluences to trade towards draws that are already there. So if there are no draws to be trading towards and you're trying to use fair value gaps, they're not going to hold really. I don't even mean really. Like if the draw is not there, you can use all the confluences in the world. It's not going to help you. These confluences are to catch these moves early. We lost on this trade. Even then, look. Bearish fair value gap. We come up, wick the crap out of it. We wick all the way above it. Boom. Close all the way down here. I entered right here. When we entered the fair value gap, when the candle had not closed yet. This would be considered an aggressive entry. And I'm not against those. But then look what happens. Price reverses back up into a higher time frame retracement. We retrace into a 5-minute fair value gap. What do we do after that? We scale back down to the 1 minute, and off that 5-minute fair value gap, we get two more fair value gaps that are made, one that we retrace into and one that we inverse. And then what do? Trade towards a draw. All I'm using is fair value gaps right now and an SMT. Guys, this stuff is not hard. It does take a lot of time and effort to understand this, but as they say, trading is the easiest way to make hard money. Hardest way to make easy money. Hardest way to make easy money, trading. So, yeah, fellas. And then while we were in the trade, we get retracement back up. We don't break above this fair value gap. And then right after this little 1 minute retrace, we bang out and then we take our profits and we're out of the markets just like that. In and out, banger trade. It doesn't get much better than that. So as I was saying, for example, okay. Oh yeah, let me get to this part. High time frame versus low time frame usage, bias forming. So for example, 5-minute, 1 minute fair value gaps are going to be strictly, I'm about to enter the market. The high time frame looks good. It's all in check. And I am going to enter a trade. Bullish or bearish, whatever I am, looking at the charts for that day. What do I think? Where do I think the market's going to go? The lower time frame, we use 1 minute fair value gaps and a 5-minute fair value gap. This is low time frame stuff. I believe on the 4-hour this day. Oh, yeah, this is wicked. There's too much writing everywhere. But I already see it. What do we have here? Bearish fair value gap. What do we do, guys? What do we do? First candle's bottom wick to third candle's top wick. Boom. Let me just delete this real quick. Boom. What do? We come back all the way down here. What do? We buy back up into it. What do? We don't inverse it. We sell off. And then what do? We sell off. We sell off to this new week opening gap that I said we would at some point. What do? We sell off to London session draws. London session lows. These draws. I'm not making this shit up. This stuff is here for a reason. We can use them every day in the markets. you need to be pairing these confluences with draws and your bias. Obviously, when what was this? Yeah, when pre-market was opening and we retraced up into this fair value gap and we swept out Asian session highs, if we're sweeping out session highs or previous day highs or anything like that, or filling some sort of higher time frame confluence, or just liquidity draws, um, I am going to be bearish for that day to see what we have to take out for the lows. I mean, this, in my opinion, this was a very easy bias, to be had. This was a very easy day that anyone could have made money on. I'm here to help you guys try and capitalize on days like this where it's pretty understandable where we want to go with price action and the market. I mean, there's so many confluences that are pushing bearish. We feel this bearish fair value gap on the 4 hour. This is stuff that's just adding to my, like, if there was just this, I'm not trading off of just the 4 hour. This 4 hour fair value gap that got filled and pushed out of, that's just filling my bias. Filling my bias with more and more stuff. Let me add that writing back. Boom. We have that. Boom, boom, boom. Wow. This looks like crazy. What did it do? Oh, I did on the 1 minute. That's why it's all fucked up. There we go. We're back. That looked wicked for a second. But yeah, as I just explained, higher time frame usage. That 4 hour bearish fair value gap is gonna be part of my bias. After I see that, I want bearish. I want shorts for the day. And then what do we do? Here, boom. Where's the draw? I don't know where. Oh yeah, I deleted it. After we come up and fill this fair blah blah blah. After we come up and fill this 4 hour fair value gap, which is right here, we sweep out Asian session highs, and then what do? We reverse. The only way that the confluence, the fair value gap, can be inversed is if it happens on the same time frame that the confluence is made. So if we inverse that 4 hour gap on the 4 hour, that is an inverse fair value gap. If we, as you can see, obviously on the 1 minute, we're going to inverse this 4 hour fair value gap. That doesn't matter. On the same time frame that fair value gap was made on, all we did was retrace. We wick up, we wick back down. Same on the 5 minute, same to the 1 minute. What do? We push back up into it, sell off. This is cake, guys. This is cake. There's not much more else that I would have ever loved to know about fair value gaps. Don't overcomplicate this. It's not a complicated confluence to use. I use them every day. You pair them with other confluences and your bias and draws to then catch a beautiful setup and a beautiful trade. Stop overcomplicating shit. Doesn't need to be complicated at all. Okay? As you can see right here, this one failed. Why? You have to ask yourself why. Why did this fair value gap fail on the 1 minute if the draw was right there? Obviously, this 5 minute fair value gap had not been retraced into. What do we want to do? On the 5 minute, you guys have to look at the higher time frame other than just the 1 minute. Obviously, we are day traders, but I mean, when we come all the way down here, we have not retraced a single bit on the 5 minute. There's a 5 minute bearish fair value gap that has not been traded into. What do? We buy back up into it. It's so visible on the 1 minute. All of this big sell off. What do we want to do before we take out the draw? Retrace back up, fill the 5 minute bearish fair value gap, and then sell back off. What do we do right here on the 1 minute? We sell off, make a bearish fair value gap. What do? We buy back up into it, sell off to the draw. Like clockwork, boys. Clockwork. This is how we run these markets. This is how we can be in and out of these markets like that. So these are what fair value gaps are. Please start, understanding and using them. This is the only stuff that I've ever used to use this confluence. But like I said, don't just use these. Pair them with other confluences. Obviously, I'm going to be making more confluence videos just like this. But I mean, don't be scared to try new things using these, but like you need to learn how to adapt to these markets. And I mean, especially now that it's the first day of 2026. I remember last year with 2025, the markets were complete ass the first 3 months of trading. I didn't know what was going on. Obviously, this is like my first couple months ever trading, but we are ready and prepared for this year. I truly believe that we are ready to, get in and out of these markets, and all the stuff that I've learned, I'm trying to teach to you guys so we can all, do this together. This is all I ever wanted to know about fair value gaps, and this is all I use to this day. I use for fair value gaps in both of my trades. Both of my trades I took this week that made $2,000. I didn't only use fair value gaps. I used them in both trades. This is a confluence that you need to pair with other confluences to be profitable. That's all I'm saying. And obviously, another thing, not obviously, I don't know why I said that. There can be multiple stacks of fair value gaps. I know, I definitely forgot to go over this, but I'm going to go over it right now. There can be multiple stacks of fair value gaps. We can find an example right here, fellas. Boom, boom, boom. We have, is that fair value gap? No. 1, 2, 3. We have 3 bearish fair value gaps stacked on each other. What happens, guys? Obviously, this is shitty price action. This is why you can't just use fair value gaps when they're just there, because you have to be trading towards a draw for them to work how they should. You can't just enter off of a fair value gap and trade towards nothing. There has to be a draw for price to fulfill in order for these confluences to work how they should. So, I mean, you don't see a massive sell-off. Why? Because we just took out the draw for the day. There's no reason for us to go any lower. We took out London session lows. There was no Asia session lows that day. So that's why there's no sell-off. There's nothing to trade towards. The main thing, if there's nothing to trade towards, get off the fucking charts. Get off. Save yourself some time, some money. Please. But what I do with these, I just mark them out as one big fair value gap. Obviously, we can inverse this first one, the second one. As soon as we inverse this top third one, that is when these are just voided. These are no longer, useful. They're gone. But I mean, well, technically they are useful, because if you're trying to catch a trade to the upside, I would need all of these fair value gaps to be voided, to be done, to be inversed. Okay. And right here, boom, a bullish example. What do we have here? How many fair value gaps is this? 1, 2, 3. We have 3 bullish fair value gaps. What do? We only retrace into one of them. That's completely okay. You don't have to retrace into all of them like this one did it? It might have damn near missed it. But we retraced into most of them here on this bearish example, and only one of them on the bullish example. That's completely fine. As soon as we break under this last fair value gap that is formed, or this top fair value gap that is formed on the bearish example, that is when it is an inverse fair value gap to the opposite side. So we inverse this first one. That's not inversing. This is one big bearish leg of just like bearish void price action. This is one bullish leg of just voided price action with no sells. So we come back down, fill it a little bit, and we come back up a little bit. Like I said, there's no draws to trade towards. So these fair value gaps in this example they're not going to work how they did in this example. Okay, why did this work so well, guys? If you guys haven't learned anything, because there's a draw to trade towards. We are using these fair value gaps to project off of what's happening to then deliver us to the draw. You see how these didn't do anything with any of this? They made these fair value gaps, but they got used, didn't go anywhere. There has to be draws to push these markets to be able to use these confluences that we all know of. So stop trying to envision that there are draws when you know damn well that those cannot even be taken out for that day, or you know that damn well it's not a good draw. Stop envisioning stuff. Start looking at what's there, what you know, and stop taking stupid trades, because these are the things that are cutting into your profits. Obviously, no one wants that. I don't want that for y'all either. I don't want it. Y'all don't want it. No one wants that. So do yourselves a favor and, take some notes of this video. If you guys if you guys didn't know anything about fair value gaps before, hopefully this video could help y'all. And yeah, so again with these examples, these are still good examples to show stacks of fair value gaps and how they work, and that you don't need to use all of them, or that you need to use inverse this one or any of that. But like, this is to anyone now that has watched this video, this is one big fair value gap. It's all the same thing. It's one big void of bearish price action that no buy orders have been filled in. So obviously we wouldn't use this as an example, because there's no draws to be trading towards, as I will hammer into your brain. But yeah, these would have to be inverse. This would have to be inverse down here. This would have to be inverse up here, to then be an inverse fair value gap for all of these to be gone, to be voided. But yeah, as of right now, huge leg of bearish voided price action, huge leg of bullish void price action. So yeah, fellas, one last thing before we wrap this up. If I know I said that, it doesn't matter what color, they can be fucking black, blue, green, purple, whatever color candlestick you make it, it's still gonna work the same way. It also, the size of them don't matter. It can be the tiniest little fair value gap. It can be the biggest one in the world. They are also going to be used the exact same. You retrace down into the area that has a lack of orders, depending on which way you're coming from, and you're going to push out of that or break through it. Like I said in my last video, there's a 50-50 shot of you getting this right. When you put it like that, your odds aren't that bad. You just have to grow some balls and really ask yourself, do you know what you're doing? And if you don't, then stop. Stop wasting your money. You need to be paper trading for months on end, back test. Anything like that where you're not wasting your fucking money, because you obviously don't know what you're doing. But like I said, if this was a bullish candle, let me see. If this was a bullish candle, this fair value gap would not matter. This is a new leg of bearish price action, meaning that there was bullish buys in this scenario. Obviously, this chain of events would look a lot different, but if this was a bullish candle, right, this would be the only fair value gap that matters. So if we inverse it right here on this one, then it's an inverse fair value gap. We don't need the entire leg. If this is oh my God, I keep saying this. If this was a bullish candlestick, this bearish fair value gap, this is a new leg of price action, new leg of bearish price action. This is still a void. This should be, instead of this big thing, it would be right here. That would be our void. Pretend this is a bullish candlestick. This would be our void that needs to get inversed or used and pushed out of. Makes sense? Hopefully that does, because that is going to be the end of this video. Hopefully you guys got, some stuff out of this, and love making these videos for you guys, so it's not really a hassle. But I hope y'all really take some notes on this video and learn, because this is all stuff that I wanted to know back when I first started out. That took me many hours of YouTube videos, countless YouTube videos that didn't make any fucking sense, for me to learn this. So I'm putting it all into one video right here. So just take the time, watch it, take some notes, learn something. It's gonna be it, fellas. Love y'all. Like, subscribe, comment if you're feeling freaky. Like I always say, peace out, boys.